Okay, Matt the Mortgage Guy here. Wanted to create a video just to talk about, is the housing market in trouble? Do we have a huge foreclosure wave on the way? These questions and more in the video ahead. And I'm making this video because in general, if a mortgage professional like me or real estate agent makes any video that talks about why we're not in trouble or why the housing market appears to be healthy, it's just that we're trying to get more business. We've got something to sell. That definitely isn't the case, but it comes across like that, or at least that's how people interpret it. So today I'm honestly playing a little bit of devil's advocate. I've made plenty of videos where I've shown forbearance data that clearly points to the vast majority of people in forbearance not being in trouble. I watched a webinar that Black Knight put on today, and thanks to Black Knight for some of the data and some of these slides that I'm going to show today. And I tried to look at it with a different lens. I tried to look at it as, almost like a worst case scenario. Could there be foreclosures coming? Could there be issues with some of these people that are in forbearance? And so this video is going to be through that lens, through a worst case scenario, or maybe, trying to see those people's opinions who kind of sit on the opposite side as me, because I'm not stuck with my opinion or what I see from one day to the next. If I see data that supports something different, I'm open to changing my mind. So without further ado, just have about 3 slides that I wanted to talk over and go over here online. As always, I'm trying to just make it simple for folks to understand, because that's how I can understand it in my brain when you got smart economists and stuff, talking through data and making it complicated. These 2 slides are basically, and this is good. This is a good demonstration. They're comparing COVID to hurricanes. It's a natural disaster, and how the market reacts to natural disasters. On the left, you've got the delinquency rate following a natural disaster. You got 3 lines. You got Hurricane Harvey, Hurricane Irma, and COVID-19. And then over here, we've got the 90-day delinquency rate. And this 90-day one really paints a clear picture, because if somebody misses a mortgage payment and they're 30 days late, that could be for a number of reasons. When they're 90 days late, it generally signals more serious trouble, right? And so as you can see, the delinquency rate, somebody gets 30 days late or something, this trajectory for COVID-19 is headed back down to, 0 would be back to basically normal. And number of months since the event, you get 10, 11, 12 months out from a hurricane, delinquency levels are basically back to normal. And what this graph is showing us is that it might take 2 years, if things continue on this trend line, 24 months, until the delinquency rates are back to where they were pre-COVID, right? And so if you look at this chart on the right, you could extrapolate a little bit of danger, right? Because this trend line for COVID-19, 90-day delinquents, has us still well above, towards the end of 2021, 2 to 2.5% more 90-day plus delinquencies. And let's be honest, 90 days plus delinquencies, these things turn into foreclosures. Once you get 90, 120, 150, 180, these houses foreclose. So if we continue on this trend line and we have, 2.5% above average, that could be cause for alarm. So I just, like the past one showed, about a year past a hurricane, you're back to normal levels, maybe 14 or 15 months on these 90-day delinquents. But that's not necessarily going to be the quick recovery for some folks here. One caveat to think about is there's a lot of 90-day delinquencies up here where they're in forbearance. And the question you have to ask yourself is, would they be 90 plus days delinquent if they didn't have kind of the backstop of forbearance? I don't know. Something to consider, right? This is something I want to look at because I think this is important. We're talking about who is in forbearance and who might get into some trouble. This data to me, the thing that sticks out the most when you look at forbearance data is that triple the amount of folks in forbearance, government loans, FHA and VA. And from what I hear, FHA is a big, big portion of this. So FHA is driving this number to be 9.3% of FHA and VA loans in forbearance. And, so maybe it's 12. Maybe it's 12 FHA and 6 VA, and the average is 9.3, but 3 times the amount. And from a mortgage broker's perspective, I can tell you that somebody who gets an FHA loan generally has a smaller down payment. They generally have lower credit scores. And this isn't judging anybody. This is facts, right? And so when I think about that buyer demographic, that buyer set, those folks have less equity. Those folks are more likely to work in the gig economy or in the service industry that has been really, harshly impacted by COVID. So this is something to watch. This is something that, somebody who put 3.5% down on their house, or, did down payment assistance and doesn't have a lot of equity. That's one area that I've pointed to where, if you look at the amount of equity in people's houses, that points towards less likely to foreclose, less likely to lose your house, because if you have 100,000 in equity, you'll just sell or you'll do something. You won't let it go to foreclosure. This portion of the demographic with less equity and less means and more likely to be unemployed right now could be in trouble. And this could lead to foreclosures. It looks like this is the total here. And this is kind of, leveled out. Part of the reason why this is leveled out like this is because we keep getting it extended. The true test is come August or so, when these 18 months of forbearance finally expires, unless it gets extended some more. If it gets extended more, then we're still going to have these same 2.5 million people just extending out, 24 months. But if it expires, that's going to be the true test, and we're going to see what happens then. Final slide. I don't want this video to be too long, but this is the positive news. This is the stuff I've shared on prior videos where you can point to the people coming out of forbearance, and the positive of that. 42% of people leaving forbearance are performing, meaning they're, out of forbearance. They got what they owed put on the back of the loan, and now they're paying their loan back and they're good. 33% of people are extending their terms. And this is something that's available. So, that's 75% right there that are basically not in danger. And then you've got 8% of people that are still in their initial original term. So they might have, waited until the end of last year to actually enter forbearance. So they're in the original term. A big chunk of this pie, 12%, just paid off their loan. They sold their house, or they got out of forbearance and refinanced. A ton of them refinanced, right? The tiny slivers are the ones that are in trouble, right? 4% are in active loss mitigation, trying to figure out, what to do. Maybe they're trying to work out some sort of deal with their servicer, loan modification or something of that sort. And then, 3% of people have been removed, or their forbearance expired and they're delinquent. Crazy part about this is most had the option to extend, but for whatever reason chose not to. And again, over here, when we look at the delinquent, this yellow portion, it's a lot bigger percentage FHA and VA than it is, GSE is basically conventional loans. It's only 2%. Then you've got portfolio and private, and this is the total market, but delinquent and either in loss mitigation or out of loss mitigation, bigger chunks on the government loans than the conventional loans. Just something to look at, something to keep in mind. It's a bunch of people's guesses right now until we actually see what happens. People come out of forbearance. So far, people come out of forbearance and they're looking pretty good. But the only problem with that is these 33% that extended, are they going to be in trouble? Are only the ones that are in trouble extending and kicking the can farther down the road, and then come August, September, we're going to have troubles. We're yet to find out, but this is concerning, right? If we've got 2 to 3% more 90-day plus delinquencies towards the end of the year than we generally have, and forbearance ends, it could cause foreclosures. Part of me thinks that 500,000 foreclosures would really help the market stabilize and become healthier than it is right now. Because right now it's so lopsided with tons of demand and not enough supply. But you never root for people to foreclose or there to be any suffering or anybody losing out. So time will tell. Just some data to look at, consider, and think about when you're thinking about the future of the housing market. Hope this is helpful. Talk to you soon. Bye-bye.